Welcome to the latest episode of The Financial Frontier. I'm your host, Patrick Camusa. As the digital asset ecosystem matures, US regulators are no longer just observing, they're actively writing the rules, building enforcement infrastructure, and laying the policy foundation that will define the next decade plus of crypto innovation in the US and abroad. To help us navigate this regulatory environment is heading I'm joined by Raj Mukherjee, former IRS Executive Director and CEO of Bodin Advisory, where he consults directly with platforms, policy groups, and builders building in Web3 and in crypto. So, in this episode, we're going to cover a lot of ground. We're going to discuss the impact of 1099 DAs this tax season, the futures around DeFi protocols, and the growing divide between US and EU policy models, among other topics. So I'm very excited for this episode. So, Raj, welcome to the Financial Frontier.
Thanks,
You've had a
Patrick.
unique career trajectory, as I briefly outlined, from the IRS to now working with many different companies and platforms in this Web3 space. So to set the stage, can you maybe walk us through your background and how it shaped your current advisory work that you're doing now at Bodin?
Sure, and thanks for the invite. Nice to be part of this podcast. So, I started my career like many people did in the traditional finance world. I'm a lawyer by education, and I have various tax teams across consulting firms and investment banks in New York before pivoting to crypto in about 2017, 2018 when I joined Coinbase as their global head of tax reporting, essentially brought in to create the infrastructure for as it was preparing for upcoming regulations, which obviously finally took a few more years to get to. From there, I took a broader role at the US arm of Binance as their global head of tax, followed by the same position at the Ethereum blockchain company Consensus. And during this time, I've had multiple interactions with the Treasury and IRS departments on the various regulations and was asked in them to run what is known as the Office of Digital Assets. Essentially, my mandate was twofold. One is to help the internal folks, the IRS Tax Council, as well as the Office of Tax Policy at the Treasury to finalize the broker regulations and help add some industry perspective and pragmatic knowledge to the talent that they already had internally. And then to set up this Office of Digital Assets, which in essence was a center of excellence that created the infrastructure for compliance and enforcement after the regs would be finalized. It was a limited term appointment, so I left earlier this and decided that I should bring my entire career in TradFi crypto, both on the private sector and as a regulator, to help clients navigate this complex ecosystem.
Definitely. So a large part of your career has really led up to this. You've been in this space for a while, and the 1099 DAs that are coming out this is really a big moment industry-wide and even just for the IRS in general. It's a very big undertaking. So I want to get your perspective on that a bit, specifically related to decentralized platforms, the marketplaces, the custodial providers that are going to be issuing these 1099 DAs. Where are you seeing, or where do you expect to see the most significant operational challenges related to this, and the biggest compliance risk for the companies that are going to be issuing these forms?
Yeah, that's a timely question. I think there are a few critical areas as these platforms adapt to these new Form 1099 requirements, which took effect for transactions starting January 1 of 25 to be reported in 26, right? So firstly, I think the data infrastructure and the historical record keeping, that represents an immediate hurdle because these exchanges, digital asset wallet providers, payment processors, etc., they will be required to provide a 9DA form for all of the digital asset sales or exchanges, right? So most platforms currently lack the transaction tracking systems or are in the process of building them, right? Necessary to accurately capture things like cost basis, holding periods, gross proceeds for each individual transaction across their entire user base. The systems integration and the workflow overhaul that's going to be required will demand substantial technical resources. As you know, the forms are due by Jan 1, 2026 for 25 transactions, and IRS penalties per form can be quite high, and so that number can go up pretty quick for filing delays, unless there's some good faith effort shown to request penalty abatements. And then platforms, therefore, must completely redesign their operational workflows to capture, process, and report this data while maintaining easy-to-use user experiences and coordinating with external software providers. So I kind of look at it as almost like not only refueling the plane while you're flying it, but almost like reupholstering the seats while you're flying the plane, while you're trying to refuel, right? I think the other area, unlike TradFi firms or brokerage who are used to collecting KYC information, this is the first time these platforms are required to do this enhanced due diligence. They will need to implement these KYC procedures. They need to collect and maintain these detailed taxpayer ID records for all their users. And as you know, as a CPA, this is not an easy task, right? And to then retain this information and then connect it to a user's transactional information, and then eventually, although not right now, having some sort of withholding obligation in the future. So it's a complex information reporting structure. I think the other thing that people also forget is that there are cross-platform transaction tracking obligations for those users that trade across multiple platforms, or more importantly, move assets between platforms, right? So if you have a wallet at Coinbase and a wallet at Kraken, and your assets in between, ensuring the accurate reporting requires a lot of industry coordination. And I think finally, resource allocation and penalty management, right? It's a great strain, especially on smaller platforms. Because this is the first ever attempt to bring digital asset transactions into formal tax reporting frameworks, these platforms must build entirely new compliance infrastructures and maintain financial risk for substantial penalties for non-compliance. So I think if you're looking at whether the Coinbases of the world or the Krakens of the world will have a hard time, I think they are in a better situation, obviously, because they've been preparing this for a long time and they have the resources. But the operational burden, I think, will be most severe on mid-tier platforms that are under this broker definition, but lack those resources. And so they'll have to rapidly develop these compliance capabilities for the upcoming deadlines.
Absolutely. It's without a doubt a huge undertaking. And I really agree with your point. Even platforms like Coinbase and some of these major platforms that may have some of that infrastructure in place going forward when it comes to a lot of these cross-platform transactions and other considerations that they really have to focus on ensuring a good user experience, which I'm sure, that's something they're diligently working on here in anticipation of these forms this year. And this also extends to, preparation, not just on the side of the centralized platforms issuing the forms, but also on investors and founders that are going to be receiving these forms as taxpayers. And that's something that I work a lot with at Camuso CPA, and that I've been preparing for from a reporting standpoint, including compliance with revenue procedure 2024-28 and how that's going to relate to the 1099 DAs. So where do you see the greatest risk or challenges with compliance and non-compliance related to the taxpayers that are going to be getting the forms, investors and founders, especially when we're dealing with taxpayers with complex transaction histories that are going to extend across many different centralized and non-custodial wallets?
Yeah, I think we can agree that this new 1099 DA rule is a game changer on both sides of this digital asset system. I think for investors, while it means more clarity, it also means less wiggle room. So like historically, many taxpayers have either struggled or failed to report every crypto transaction, especially its activities across multiple wallets and exchanges. Starting with the day, brokers will and the IRS the form that looks kind of like what you get for your stocks and others in the TradFi world, right? So proceeds, cost basis, date of sale. So it reduces, on one hand, the DIY headache for tracking transactions manually, but it also means any underreporting or misreporting reporting will get picked up, or most likely by the IRS's matching system, or lead to individual audits, right? Which is new in the crypto world when it comes to the actual investors and the users there. I think for founders and platforms, the burden is heavier. I mean, if you're an exchange, wallet, or protocol falls into the Treasury's definition of a broker, then you may now have to collect customer information, do the calculation of gains and losses, issue the annual tax forms. And that's not really just a compliance challenge, it's a design and operational challenge, right? Particularly if the business is sort of straddling the line between DeFi projects and custodial regs, and the early stage companies weren't built with these lines. So I think in short, they get more certainty and fewer surprises, hopefully at tax time, but founders face a new layer of regulatory compliance that could influence how they structure models going forward.
Absolutely, and new founders should definitely take these sort of compliance considerations count initially at the inception when they're designing protocols and their companies in general, and just trying to build this into their infrastructure. So,
yeah, and the one thing I'd add to that, Patrick, is that while it's difficult to create systems, especially operational and compliance, and I know we're going to get into DeFi in a minute, but to future-proof, but I do think that it's important for founders who are creating products that may be in scope of reporting or any of that, to somehow keep things flexible and open-ended, because I think, as we both know, regulations are never static, neither is blockchain technology and crypto. And what may or may not be reportable today could be in the future, and you don't want to box yourself in a way that it would be far more exchange any of your processes and systems in the future.
Absolutely, I completely agree there. You need to be positioned for all forms of compliance and regulatory changes that can arise in the future, which brings me to another point. Last year, when we saw the proposed broker regulations, there was a lot of discussion around this within the industry, but the DeFi space avoided being pulled into the final broker regulations. So what's your take on that? What do you see for the future with non-custodial platforms and protocols?
Yeah. So the DeFi space was, as you know, fully captured in the non-custodial final broker regs that was released at the end of last year, and it would have required self-custodial digital wallet providers, for example, and other developers of non-custodial software to submit the information reports to the IRS. Famously, it went through a congressional action through the CRA, and President Trump signed the legislation on, I think it was April, right, in 2025, those obligations. So I think looking forward, the non-custodial platforms and protocols will eventually face some form of reporting obligations, I feel, but likely through more targeted and technologically informed approach rather than the broad scope of broker reporting that was repealed. I think the Congressional Review Act repeal creates a unique situation. These regs, as you know, could not have been repealed in this measure because of the 60-day limitation under the CRA, meaning that this specific regulatory approach cannot be reintroduced by the current administration. However, future administrations with different priorities could pursue alternative regulatory frameworks to address these same issues, right? I think the technical realities create pressure. The fundamental challenge is still there. Traditional financial institutions are increasingly required to report customer transactions, while the DeFi protocols facilitate billions in taxable transactions with minimal reporting. And this creates both a competitive imbalance, I feel, and a significant tax gap that Treasury is likely to eventually going to need to address, especially as we know DeFi adoption is growing and transaction volumes are multiplying significantly. But I think when the regulations do return, I think they will likely in the next probably 4 to 6 years, they'll probably be more sophisticated rather than treating all DeFi protocols as brokers per se. Future rules might distinguish between like different types of non-custodial services based on what their actual keys are to collect user data and their role in actually facilitating the transactions, right? I think the DeFi space itself is towards greater compliance infrastructure. As you know, many of the protocols are implementing voluntary compliance measures. User interfaces are becoming more sophisticated and tracking transactions, and institutional adoption is high, so that's driving a demand for more compliant products. Yeah. So I think this is a natural organic evolution towards may not be a regulator imposed compliance, but almost as if the protocols them creating sort of a self-sustaining compliance structure that is less disruptive and more organic to their composition, and might give a clue and help the regulators in designing what compliance systems work for the DeFi world. So I think the reprieve, if you want to call it that way, is temporary. I think the question isn't whether non-custodial platforms will eventually face reporting obligations, but rather when and in what form. I think it'll be a combination organically evolves within the technology and the regulatory understanding of that.
Yeah, and that ties back to your point of, as a company that wants to have staying power in this industry, you need to be building with this in mind, not just what the regulations are now under one administration, but what are they going to look like 5-10 years from now? And are you going to have staying power with the way that you're designing the infrastructure around that? And to your other point as well, as you start bringing to your platforms, having these compliance protocols in place and the reporting for investors starts to become a feature rather than a burden a lot of times for companies. So that's another consideration. And to your last point, the industry, as an industry, not even just as a company, if you're able to get ahead of the compliance and everything around DeFi, we can help shape the final form that it may take in the future as well. So it's a very important condition for each company, each protocol, but also an industry as a whole.
The other thing I would add to that, Patrick, is that more and more users are demanding a global access to digital assets and other such products. We already know that you and some of the other jurisdictions did include the DeFi section in their regulation. So I think anyone building their products or their company that is going to DeFi products and wants a global reach will have users that will require that such compliance measures, right? So I think that's another point about thinking to the future and when building.
Absolutely. Any company really that's operating in crypto isn't just confined to one jurisdiction. The users are always global, so that has to be taken into account. Not just the U.S. regulatory environment, but the global regulatory environment, because compliance is non-negotiable in every jurisdiction. And there's going to be a lot of unique considerations around that related to KYC, I think. So it's going to be interesting to see how this takes form. Is there anything that you would suggest or you'd like to see different in the current broker rule framework? Any additions that you would make, or clarifications, or any suggestions that you would have just based off of the work that you're doing now and the industry feedback that you're getting, or anything else that you've seen? Yeah,
I think starting with the caveat that having grown up in the private sector, I think I not have an appreciation of the complex work I have to do when writing regulations till I became one and had to put pen to paper, right? I think this is something that I think the industry also needs to be a lot more sympathetic about. But having said that, I think the current approach creates some disproportionate burdens. So if I were rethinking this, say, implemented more of a tiered system where smaller platforms with, say, under 10 million in annual digital asset volumes face a more simplified reporting requirements, whereas major exchanges maybe have a full compliance obligation, right? So like, for example, this recognizes that if you're a crypto ATM operator, you shouldn't face the same level of regulatory burden as a large custodial exchange, fill in the blank with the name. Well, and you can still capture the vast majority of taxable transactions, right? I think the framework also needs explicit safe harbors for genuinely non-custodial protocols that lack technical ability to just collect information, because unlike traditional, brokerage and traditional sort of payment flow, that there's not often a clear agent-agency relationship in the payment structure. So I think these safe harbors are important. And I think this would also protect open source developers and truly decentralized protocols in the future, while maintaining oversight of the services that do have meaningful customer relationships and data collection capabilities, right? And I think industry feedback has also highlighted that the challenge of users trading across multiple platforms. I think I touched on it a little earlier. I'd like to see a mandate of industry-wide adoption of standardized transactions that require platforms to participate in a secure information sharing protocol that prevents double reporting, but also ensures like the customer transactions are covered, right? And then I think the other part I feel quite strongly is that rather than requiring immediate compliance for all the transactions, why not implement a phased approach, starting with the simple, say, spot trades, for example, and then gradually expanding to more complex products like derivatives, staking rewards, and then eventually DeFi, things like DeFi yield farming, right? I think this allows both the platforms and the IRS to build the expertise and the test environments and, progressively, because anybody who's done reporting knows that it takes at least 2 or 3 cycles to get it right from both sides with the best amount of efforts, right? So why not do that? And I think the current rules also lack some clarity on how platforms should handle cost basis for transactions that involve multiple assets, or like algorithmic trading or liquidity provisions, for example. So I think more guidance on, FIFO, LIFO, and Spec ID with standardized defaults and that reduce platform liability could produce some good faith and help in the calculations. And I know that the IRS has been very good in understanding the complexities of building such systems and penalty relief or good faith efforts. But I think the penalty relief doesn't adequately distinguish between true good faith compliance and willful non-compliance. So I'd implement sort of more graduated penalties to consider platform size, compliance history, nature of any violations, with penalty relief for platforms that actually truly demonstrate substantial compliance efforts. And then the other thing that I think is quite important is that we have some very important trade associations that are involved in this world, right? And then you have some industry advisory committees. I think there is a formal advisory committee that represents major exchanges, smaller platforms, DeFi protocols, tax professionals that see sort of the everyday effects of this, and also consumer advocates, right? I think creating something like that informal basis that could meet with regulators and discuss issues on a, maybe a 6-month basis or a yearly basis as the market evolves and products diversify will help alleviate some of the implementation surprises. And then finally, I would say rather than defining specific technologies or protocols, focus more on functional definitions based on what services actually do for customers, right? So this prevents the rules from becoming obsolete as new technologies emerge, and ensures that consistent treatment of economically similar activities, regardless what the underlying technology is, right? I think these revisions could create a much more nuanced framework and achieve the underlying policy goal of tax compliance, while also recognizing how quickly this ecosystem evolves and how diverse the markets are and the user bases are and the technology is. And I think it'll help sort of alleviate some of the tension on both sides.
Yeah, these are great points, because a lot of times you'll get on the industry side is that these types of regulations can stifle innovation. But when you consider some of those suggestions around the tiered approach at the transaction level, at the size of the company, and even how you phase in the regulations with the different types of calls, taking these steps, not the IRS build the infrastructure, but it helps also have that interface potentially between the IRS and people in the industry, and allow to have a form of regulations that don't stifle innovation, that allow to have that growth and to have smaller non-custodial DeFi protocols pop without getting completely slammed with the same reporting requirements of a company the size of Coinbase, and allowing them to adopt new protocols or new assets or new ways of transacting without completely letting it off from the start because of any concern with reporting requirements. So taking that type of approach can really go a long way to where we can start maturing the industry, start getting closer to full compliance without stifling innovation. So I really think that those are some interesting points that you raised there.
I also think one more to add to that. I think it is vitally important to have a more loose, sort of friendly, collaborative public-private partnership.
Yeah.
And I know there are things like URSAC and there are things, but these are all very formalized relationships, right? And I think that, some of the environments, like, for example, the SEC is creating by inviting creation of regulatory sandboxes without the fear of penalties, for example. I think if Treasury could follow some of those in the same areas of taxation and just conversations, I think at the end of the day, that would be beneficial on both sides.
Absolutely. Yeah. The sandbox and increasing communication as well. And where are you seeing, or where have you seen the greatest communication breakdown? Is it lack of sort of, some of industry organizing to interface with the regulators, or is there something else you're seeing, or can we start to fix some of these issues in your opinion?
That's an interesting question, because when people have asked in the past why I decided after almost a 16-year career in the private sector to go and take the position I did in the government, I think I have answered it because I saw through the few years of working in the crypto world that even with the best of abilities and best of intentions, the government industry were sort of talking past each other. And I think that was my motivation to say, maybe I can value add, right? And I think, to your question, one of the deepest disconnects occurs in my technical feasibility versus regulatory expectations. So like what I mean by that is regulators often assume that because traditional financial institutions can implement certain requirements or reporting requirements or structure, the crypto platforms be able to do the same, right? But as we know, crypto platforms frequently operate with entirely different technological architect, data structures, and frankly, experience, right? Many of these startups are not your Charles Schwabs of the world, right? They haven't been around for 100 years. So when the IRS says something like, just report cost basis like stockbrokers do, they may not fully grasp that crypto transactions often involve these multiple assets or algorithmic trading, etc., like neatly mapped to traditional securities concepts, right? On the other hand, I think crypto companies are onto regulatory protocols with technical objections without adequately explaining the broader compliance implications or offering workable alternatives. So even from my own personal experience, when I sat across the table with many of my former colleagues in industry, compatriots, and they would say, oh, this is not going to work, I would often say, well, okay, that I get that, but tell me what will. Because regulators have regulations per some law that has been passed by Congress, right? And so not writing a law is not an option, but they are, and they should be helped by the industry in figuring out, okay, maybe, when we are talking about data schema for KYC, maybe the traditional W9, W8 that we all are used to in brokerage world doesn't work for the crypto, but what does? What can be collected while balancing concerns that crypto users have? So I think that is going to be, that has always been a huge gap. And I think, on the other hand, I think regulators also operate on policy development cycles that are measured in long periods of times, months and sometimes years, whereas, as we know, crypto markets evolve in months and weeks, right? So by the time comprehensive regulations are finalized, the market structure that they could have already changed or can be non-existent, all the same. And I think that if you look at the 1099 DA development, I think it shows some of these signs, right? Like the rules were developed where centralized exchanges were the dominant feature. But by the time the implementation happens, it's DeFi protocols and asset tokenization and things like that are handling the massive amount of transactions and numbers in terms of dollars, right? And the rules were designed to address that, right? Exactly. But then on the other hand, I think that a lot of the times the crypto companies demand immediate regulatory clarity, right? For business models that they may or may not even have finalized themselves, and it's in sort of experiment stage. So, and that's an unrealistic expectation about how quickly these frameworks can be developed. And I think the most effective solution in my mind is again, going back to that can operate continuously rather than only during rulemaking process. So not just like a comment period after those rules have been finalized, but groups that interact with the government, with like technical staff from major platforms who understand what it is to implement rules, IRS, maybe system architects, understand the agency's data processing capabilities and limitations, right? Tax professional like yourself, me, who have seen like the variety of implementation and compliance challenges. And then to some extent, even maybe some academic researchers that can provide some neutral technical analysis. I think if you look at institutions like the IMF and the World Bank, when they do these, they bring in academic that do research, and they're nonpartisan. They don't have a stake in the game, so they can sort of observe it from a neutral perspective and provide solutions. Maybe anyone with a vested interest on either side couldn't. So I think all things could have your major impact. Final thing I'll say is I think it's important to create mechanisms where the industry can proactively inform regulators about emerging technologies and market structures, and that might create not only a divergence from the rules, but also maybe compliance challenges that the regulator thinking about, right? I think effective crypto regulation requires this ongoing technical dialogue, not just pronouncements of policy, right? I think a sustained collaboration between people who understand both the technology and the tax system, working together to solve the practical problems rather than sort of defending institutional positions, is the way to go.
Yeah, definitely. And there needs to be that interface between industry and the IRS and flexibility on both sides, because like you said, we're operating on, just like this podcast, it's called the financial frontier. New transactions, new blockchains, new ways of business. You're not going to be able to spin up regulations for that next week. And you need the ability on both sides and communication on both sides to really help the future of policy here in the US. And kind of how we were discussing a little bit earlier too, this isn't a regulatory vacuum. We exist within a global economy, and crypto is really no exception to that. It really is one of the best examples of it, because you can transact on chain with someone anywhere in the world, of course, and people do every single day. And Raj, I know you do a lot of traveling, and you've seen a lot of different structures and work with people, all regulators and private businesses. So could you compare and contrast a little bit, the U.S. regulatory framework, which a lot of people would call more fragmented when we're looking at tokenized assets, compared to the EU's more harmonized approach under MiCA, and how is that going to impact jurisdictional flows and where people do business in the future? And maybe with that tie in some of the considerations around the token standards with real world assets, and your thoughts on that as well.
Yeah, I think the contrast between EU's MiCA framework, which is the markets and crypto asset regulations, and the US's regulatory approach, I think is one of the most significant competitive dynamics reshaping this global crypto world, especially when it comes to capital allocation, right? I think there's increasing visibility impacts where the projects are launched, where the institutional capital deploys, and where innovation occurs. And I think a lot of that is designed within these almost compare and contrast type regulatory frameworks. I think the MiCA regulation institutes, uniform EU market rules for crypto, and it creates, or it attempts to create at least, a single regulatory framework across, I think, 27 member states, right? I think crypto asset providers are able to provide their services across the EU jurisdictional border. And it's almost kind of like a passport, right? From other, which is also kind of famous from other EU finance regulations. And I think this is in contrast to the US. The crypto companies have to navigate SEC regulation, CFTC commodity oversight, state-by-state money transmission licensing, banking regulators, FinCEN, a bunch of these things, which can often be overlapping or conflicting, and there is no clarity, right? Now, I do know that the Clarity Act is going through, and that's going to create some clearer definitions on who's responsible for what. But I think it is safe to say that even as it stands today, who handles what is not clear, right? And so that's definitely a challenge. I think the EU regulation, is a landmark moment for high-profile crypto asset sectors. It already came into existence in 2024, which means that we're now actually able to see what the real-world implementation efforts would look like, right? So, starting to drive the CAS, so the crypto asset service providers, had to begin applying for licenses, right? In the EU, there's evidence though that a majority of them are still struggling to meet these new standards because of costs and requirements, but nonetheless there is a uniform licensing requirement. But I would argue that even these compliance burdens, it's definitely creating a competitive. It applies to any business serving EU customers regarding where the business is based. I think this gives EU a much more extra territory that I would say the U.S. regulations often lack for this moment, because we are, as you know, at the moment when it comes to crypto transactions within the United States. And I think these regulatory divergences are also creating, I think, a number of capital flow patterns. I think European institutions I see are increasingly having a clearer regulatory pathways for crypto investment through MiCA, while in the US, the institutional investors still have to navigate a lot of regulatory uncertainty. I think this is evident in the asset tokenization space, where European banks and asset managers can develop these tokenized asset products a lot faster and quicker, and you're seeing more proliferation there. I know of a number of companies within the U.S. that have not been able to launch asset tokenization with the kind of flexibility and clarity that they want. So they have actually done their first rounds of asset tokenization projects outside of the United States within the OECD and EU jurisdictions because of it. And then when you look at new crypto projects, those involving sort of RWA tokenization or sophisticated DeFi protocols, they are increasingly in EU jurisdictions, or they're increasingly obtaining MiCA licenses for the unified European market, again, because of this regulatory clarity, right? I will tell you that one of my clients that I am a global regulatory advisor for is a global platform development known as Finternet. And Finternet is essentially trying to create the highway for an jurisdiction agnostic tokenization platform, a true peer-to-peer asset collateralization platform where you, if you have a real-world asset, can tokenize and collateralize with somebody who wants fractional ownership in said jurisdiction, right? Now, this has got a lot of international backing, right? And it's a very, very interesting way of looking at how to tokenize and address and open up the value of stagnant real-world assets, right? But I can tell you the regulatory sandbox is yet quite unclear in the United States, and we're working to figure that out with conversations with the SEC, FTC, CFTC, state regulators, whereas the pathway to that is much further on places like Singapore, places like Switzerland, and things like that. So I think regulatory clarity is a really important thing when it comes to asset tokenization in general. And I think under MiCA, it's encouraging development of compliance infrastructures, custody solutions, institutional and grade services much faster than it is in the United States. And I think the other thing to point out is that MiCA and the Genius Act, for example, present two very converging approach regulations, right? But the timing advantage heavily in favor of the EU, because the US is still debating these comprehensive. European companies are already building compliance capabilities and market under these rules, right? So this regulatory first mover advantage is really important. See this in things like stablecoin infrastructure. So like MiCA has a very comprehensive stablecoin framework that provides much more clear operational parameters than the US banking and securities regulations. tokenized securities, which I already talked about, and then even institutional custody, right? European custody providers can operate across 27 jurisdictions in the EU with a single license, whereas the US providers still, I believe, face state by state licensing requirements. So I think these things have a dynamic effect on long-term competitiveness, right? And the EU is almost at the moment positioning itself as the preferred jurisdiction for compliant institutional grade crypto innovation.
Absolutely, that's a great point. The speed at which this regulatory change gets implemented in different jurisdictions is going to be a huge factor in the future, the success of different jurisdictions and companies, and for different founders and platforms that are setting up their company structure. They need to be speaking with the right advisors and understanding the implications of where are you going to operate from and how are you going to structure your business, because that can be a huge advantage for your company if you choose the right jurisdiction over another company is in a jurisdiction that's going to have you moving slower than a competitor, or another version of your could have domiciled somewhere else. So Raj, I think there's so many interesting developments that are coming down the line from a regulatory standpoint here in the US, and companies need to be taking this into account, the global regulatory environment, because it's a competitive advantage, right? And it can hurt you if you get it wrong. So can you tell us a little bit about your consulting practice at Bodin Advisory and the type of companies you're working with? And are these the type of things that you're working with, with these companies, or what type of engagements are you focused on? And how are you helping companies prepare for, the current regulatory environment and some of these changes that might be coming in the future?
Yeah, no, thanks for that question. I think I find myself in a very unique situation, right? Because as a former regulator that transitioned from industry to being a regulator and then back to industry, right? I find myself in a very interesting sort of position in digital asset policy development, because I have both sort of the institutional knowledge about how rules are written, what the intent of those rules, why the intent is expressed the way it is, on one hand, but also sort of the industry operational and technical and resource challenge, having sat in those seats as well. So I think because of this, and also, as I mentioned in the beginning, 14 plus years in TradFi and financial institutions where I oversaw policy, tax, operational programs, I think where this particular practice for Bodin is important is it's at the junction of regulatory requirements, tax complications, policy lack of clarity together, and matches it with sort of the blockchain and Web3 and crypto space, right? With someone who has a heavy understanding and upbringing in the fundamentals of financial instruments and how that works. Because as you know, and as I know, many of the products in the crypto world are a diverse version of what we already have seen or have, or experienced in the TradFi world. So I think understanding how payments flow, understanding what is the reality of an implementation cycle, understanding how to even know vendor technology and what it takes to create that operational framework is vitally important, right? It's not just about the crypto technology or the understanding of the tokens, but these fundamental spokes in an entire compliance framework. And I think that's what I bring to the table, right? I think I understand how regulations get implemented within government agency. It's just from a policy as well as an operational. But I can also translate between regulatory and industry languages, right? And helping policymakers on one hand understand why certain compliance requirements are disproportionate, while helping industry understand the legitimate policy concerns. I think where I have, worked so far, and admittedly, I've been in business for 3 months and a bit, much shorter than you, Patrick. So I want to grow up to be you. I've done a lot of work on tokenization platform, and it's a fascinating area of work because again, like most other crypto products, it's developing globally at a fantastic speed. People understand how much collateral is locked, but at the same time, governments and other agencies around the world, not just in the United States, are still struggling to figure out some of the more complex issues. Like, I'll just point out one. You have a real world asset. You get an independent valuation of it, and somebody says it's worth $100,000, right? You go, great. You tokenize it, you advertise it as available. You have investors from around the world that have fractional ownership in a fifth of your assets. What happens if you decide to actually sell the actual asset versus a digital, right? And it's not just a tax issue, it's a compliance issue, it's a legal issue, it's a property right issue, it's a commercial use. I mean, there's a plethora of issues that are very fascinating for someone like me to work on. So again, with Fintranet, for example, I them understand what regulatory sandboxes they can play with in the various jurisdictions they are, and where are there harmonies in regulation. Where do we need to talk to the regulators in bringing them to the table and creating a really sort of peer-to-peer transaction highway for real-world assets. I'm also working with more on the more traditional side of tax, where you have foundations and portfolio companies and say the Caymans and some of these other jurisdictions that may or may not have U.S. nexus, right? And they're invested in digital assets. I'm in conversations with family office people who are realizing that a lot of their complex investments also involve crypto, and that requires a lot of a different type of compliance. And then finally, I think I'm also working with a number of organizations and helping them or partnering in writing white papers, policy papers, more educational content that can go out to its youth, that can help them conduct education sessions. And I've also been asked to sort of create those programs because the lack of understanding is what makes crypto cryptic. I think at the end of the day, if people truly understand what the asset type is and what the volatility is, or what the repercussions are in investments and whatnot, they can go into with eyes open. So what I love about my practice is because of the career I've had, I'm able to address a number of diverse issues within this ecosystem.
Yeah, and the timing is perfect as well, right? Because the industry is reaching that degree of maturity where they need that combination of regulatory experience and traditional Web 2 experience with combined and packaged into someone that understands Web3 founders work and how these transactions flow on chain, because it is very unique and it needs all three mental frames combined are very powerful for someone like the company you mentioned, where they're looking to tokenize assets. That is, you need to consider all the jurisdictions, the unique considerations with how these assets are tokenized and how those transactions flow on chain. So it really is a unique combination of skills that are needed, but it's really what's necessary if we want to see, because if we want to see a higher degree of compliance, there needs to be private consultants like yourself and Bodin that are able to bridge this gap and able to take these companies and get them closer to compliance and navigate complex regulatory environments.
Yeah, I think it's important. I'll say one more thing. I think we're at that precipice where you have both crypto natives as well as TradFi institutions coming into this ecosystem. So, for folks like myself who've had the experience of working for the JP Morgans and the HSBCs of the world, but then has gone on to work for the Coinbases and the Binances of the world, and then the government, I think even from just a leadership and just strategy perspective, right? I've seen the playbooks of all these different areas, and I think it's not, as you appreciate, when talking about things like tax and compliance. Yes, the actual tax and compliance work is important, but understanding the contextual framework, how founders think and how technologists think, right, is really important. I used to always tell internally when I worked at IRS and in educating folks internally about the industry, I would always say, fundamentally what I realized is the main difference between TradFi and this crypto world in digital assets is in the TradFi world, you have financial specialists and lawyers and that are creating products and creating infrastructure using technology. Whereas in this world, it's technologists that are creating financial products, right? And I think fundamentally, those are two different ways of thinking about go-to-market strategy, about returns. And I think those of us that have had the good fortune of sort of building a career that touches all of these are able to then resolve a number of issues that are not linear in nature.
Definitely, I completely agree. Combining that experience, it's really that time where the industry has to and start to, take the Web3 ecosystem and, start meeting the regulators and doing it the right way. It really is going to push the industry forward and really decide how the next decade looks in the US in terms of progression here. So I'm really excited to see where things go from here. And also excited to see what you do at Bodin Advisory, Raj. So for listeners who do want to reach out to you and learn more about your work or explore, advisory and working with your firm, how is it best to connect with you?
Yeah, I mean, they can kind of touch base with me on the website, which is bodin-advisory.com, or they can shoot me an email at Raj Mukherjee at bodin-advisory.com. If either one of those is tough to find, you can find LinkedIn. That's the way. I'm often in a lot of conferences as well, so I speak quite often. So just grab me or send me a DM.
Yeah, I definitely see you traveling around to all the conferences. So I know I'll probably be seeing you at a conference here soon. And yeah,
we should figure out a way to be on a panel together, actually.
Yeah, definitely. I agree. Hopefully maybe in the fall or Q1 we'll
find sounds good.
So, I do encourage everyone to reach out to Raj. He's on LinkedIn. He's posting a lot of great content on there, a lot of great updates. I follow him on there. So definitely follow him on there. And if you do want to work with him, reach out to him at his website, bodin-advisory.com, and set up a time to speak with him. So that's it for today's episode of The Financial Frontier. I just want to say a big thanks to Raj for, breaking down where crypto tax enforcement is headed from 1099 DAs to the global regulatory landscape. It is one of the most important topics for Web3, in my opinion. So I encourage everyone to like this episode and share it around within the industry. And like and follow The Financial Frontier on whatever platform you're watching on, if you did enjoy this episode and you got some value from it. So thanks to everyone that's listening. Thanks again to Raj. And until next time, I'm Patrick Camuso signing off.
Thanks, Patrick.